If you opened a standard economics textbook, you'd probably walk away believing the global financial system was carefully engineered by governments, drafted in parliaments, managed by central banks, and fine-tuned by economists with tidy theories and neat diagrams. But that version is the sanitized one. The real story is older, stranger, and far more human. Because long before governments created institutions, long before anyone imagined a financial sector, money was already racing around the world. It didn't flow through banks or regulated markets. It moved through people, through private alliances, merchant clans, religious brotherhoods, trading guilds, secret societies, and family dynasties whose trust networks stretched across continents. The first global financial system didn't run on legislation. It ran on relationships, on reputation, on loyalty, and often it operated in the shadows. To understand why these networks emerged, you have to picture a world so unpredictable it would feel alien today. A world without central banks, without stable currencies, without deposit protection. Without anything resembling modern finance, the value of your coins changed every time a king needed revenue and quietly shaved silver off the edges. Sending money abroad meant risking pirates, plagues, wars, corrupt border guards, and bandits who didn't care what your legal rights were. This wasn't just a risky environment, it was financial chaos. And in that chaos, identity, not law, became the passport to safety. If you were part of a community with shared language, rituals, and obligations, your wealth could travel thousands of miles. If you weren't, good luck. You were on your own. That's why the earliest global financial infrastructure wasn't built by nations. It was built by networks. One of the most remarkable examples was the Jewish merchant diaspora. For centuries, Jewish traders, later expanding into Sephardic and Ashkenazi webs, became some of the only people who could move money and goods freely. Between Christian Europe and the Islamic world, where kingdoms clashed, they navigated. Where borders hardened, they found roots. They trusted one another when states did not, and through that trust, they created one of the first stable international credit systems. But they weren't alone. Across the Mediterranean, the Venetians and Genoese were constructing something that looked suspiciously like early financial empires. Their merchant houses invented forms of insurance, credit partnerships, and joint ventures that still echo through modern banking. They built fast-moving information chains using ship logs, coded letters, and diplomatic gossip. Venice functioned almost like a software platform, a commercial operating system powered by trust and data. Genoa, meanwhile, became Europe's risk-trading powerhouse, financing Spain's rise with a network of bankers operating like proto-hedge funds. Further north, another kind of network took shape, less a family than a corporation. The Hanseatic League, a federation of merchant cities, Hamburg, Riga, Gediga, Issyk, and Manimore, that acted as a unified commercial empire. They standardized contracts, enforced their own trade laws, and used joint fleets to secure entire sea routes. The League proved something revolutionary. A disciplined network could outperform kingdoms many times its size. Meanwhile, further east, a quieter but equally powerful diaspora was weaving a financial web across continents. The Armenian merchants of New York. In the 1600s, their trade routes connected to Amsterdam, Bengal, East, and Manila into a single operating system. They moved silt, silver, spices, and credit through hostile borders, using nothing but trust. Family correspondence, and their own internal courts. European and Persian rulers relied on them more than on their own bureaucracies, because their word was worth more than a treaty. Everywhere you look, the pattern repeats. Wherever states failed to provide trust, networks provided it. But one of the most dramatic networks in early finance didn't come from merchants at all. It came from warrior monks, the Knights Templar. Founded to protect pilgrims, they accidentally stumbled into the world's most powerful business: financial services. They built fortified outposts across Europe and the Holy Land, accepted deposits, safeguarded wealth, and issued coded letters of credit, redeemable thousands of miles away. They basically invented the international wire transfer, and they became so rich, so secretive, and so essential that in 1307 the King of France, desperate for money, destroyed them. Their network didn't die, though. Its methods seeped into later institutions and merchant alliances. By the late Middle Ages, the center of gravity shifted toward powerful banking families, Tevardi, Peruzzi, Medici, and later the Fuggers became the financial backbone of Europe. They built branch networks, used encrypted letters, and moved information faster than royal messengers. They funded wars, crowned emperors, stabilized currencies, and bailed out monarchies. The Fuggers alone financed the rise of Charles V, proof that private credit could reshape geopolitics more effectively than any army. But financial power wasn't just about money. It was about knowledge, and no network mastered knowledge like the Jesuit order. Their global network of schools, missions, and scientific observatories spanned continents. They mapped coastlines, documented trade patterns, studied local economies, and advised kings. They weren't bankers, but they controlled the information merchants and monarchs needed to operate. In an era when information was a currency, the Jesuits were the world's most influential brokers. As Europe entered the Enlightenment, another network stepped forward, one built on secrecy, symbolism, and trust. The Freemasons. Their lodges became meeting hubs for merchants, scientists, politicians, and industrialists. A Masonic handshake could secure a deal more reliably than any contract. Early bankers and industrialists joined not for mysticism, but for something far more practical, a dependable network in an unreliable world. And then came the family that transformed networks into an art form. The Rothschilds. They didn't invent international finance. They perfected it. Each brother stationed in a different European capital, each connected by coded letters and private couriers, each operating faster than governments, newspapers, and intelligence agencies. The Rothschild network created the first truly synchronized global financial machine. They moved money across borders that were technically at war. They financed railways, stabilized currencies, rescued governments, and traded information with a speed that left entire nations breathless. They were the final masterpiece of the old world of private networks. But as the 19th century progressed, governments started building their own financial infrastructure. Central banks, stock exchanges, national bond markets, public institutions expanded, yet the networks behind them never disappeared. They simply merged with the new architecture. And that brings us to today, a world that appears orderly, regulated, institutional. But behind the polished surface, the old machinery still hums. Shadow banking resembles the unregulated credit webs of Venice and Genoa. Eurodollar markets functioned like modern diasporic finance. Offshore banking behaves like a digital age Templar system. Venture capital networks and elite business forums operate like modern law. Global intelligence agencies gather information like Jesuit scholars. And multinational corporations coordinate like Hanseatic cities. The architecture changed. The function did not. Every modern financial crisis exposes the same pattern. In 2008, laws failed, but private relationships determined which institutions survived. During the Eurozone crisis, influence networks mattered more than legal frameworks in the rise of offshore finance. Private webs of accountants, lawyers, bankers, and CEOs designed systems faster than any regulator could react. This isn't conspiracy. It's structure. Finance has always depended on trust networks, and trust still moves through private channels long before it appears in public systems. That's why, in every crisis, those with access to the right networks survive, and those without pay the price. The modern economy looks institutional, but beneath the surface, it still runs on networks. And the deeper you look, the more you realize global finance was born in the shadows, and even now, the shadows still shape it. If this changed the way you see the world, hit subscribe. History has the answers. I'll help you find them.